right there. We're going to kick off the 4:20 session here, 4:20 Eastern Time session here with NFI Group. Thank you all for joining us. It's my pleasure to have Paul Soubry with us, President and CEO of NFI Group. I'm Kevin Chiang. For those that don't know me, I'm one of the analysts here at CIBC. We are gonna have a fireside chat format. So for those that do have any questions, please use the app, and I'll see those questions come my way. Otherwise, Paul and I have a bunch of questions to go through on our end. So again, Paul, thank you for joining us for this conference. We really do appreciate you being here. Maybe I'll just start with your recent update that you provided on Friday, the updated outlook for 2021. And maybe I'll just leave it there. Why don't you tell us, kind of what's happening on the ground today and what are some of the pinch points you're seeing?
Well, look, thanks for having us, Kevin, and the opportunity to give the update. As you know, our industry is an essential service. We're building buses for public transit, and in some cases, private motor coach or private operators performing public transit. COVID has not been kind, all the way back to the beginning of 2020 in terms of first implications for ridership, stalled fleets, idling fleets, moving first responders and so forth. Of course, none of us knew how deep, how far, how wide, how long it would take, and none of us expected 4 waves and who knows what's next. So last year, what we did is we idled our facilities, we slowed down production rates, we managed through COVID as best we could. We took advantage where we could of government wage subsidy or furlough schemes in the UK and so forth. And, we survived a really delicate and difficult year with our business intact. Surprising to us to some extent is the nature of our supply chain is highly variable, highly customized. And in 2020, we really didn't have any supply chain dynamics that would actually hurt or impact our ability to build buses. So it was more a volume discussion, delayed orders, delayed publishing of fleet replacement plans and so forth. And then, of course, the full idling, if you will, of the private motor coach fleet. So we start off 2021 in not a bad place. We've got a reasonable backlog of both firm and option orders. We, rebounded in terms of bringing the volume back up in some of our plants. All the plants got back up and running. And when we started the first quarter, we actually had reasonable numbers. We hit our plan. We delivered the number of units we thought we would. We really didn't have any significant supply chain issues. Now, our products, just to remind our listeners, are highly, highly customized. Like seat layouts and window are different, and air conditioning systems and engines and propulsions and everything. So we're building highly engineered, highly customized products on an assembly line. As we got into the second quarter, we started to see some real signs of material challenges, and we saw a mix change. So, for example, our volume of New Flyer buses that we thought we would build throughout the year started to slow, but the motor coach business actually started to recover a little faster than we might thought. And we were selling off units that we had in finished goods inventory. So net, as we got through the first and the second quarter, we still believed we could live inside the guidance we had provided to the street of 220 to 240 million EBITDA this year. Now, every month, what we do, Kevin, is we meet with each of the management teams of the businesses, and we go through full year actuals, forecast, mix, volume, margins, balance sheet, working capital, receivables, and so forth. And we do that, the last time we did that was mid-August, and then we did it again in mid-September. And as we got closer to the mid-September reviews, we started to see serious cracks in the supply chain. Now, we don't order zillions of chips from any chip manufacturer. We buy products from, Allison or Cummins or whatever that have microchips embedded in them. And we are all well aware of the challenges upstream of those people getting those things. But when we started to get notifications of things like battery supply, we would get a portion of what we intended for the rest of the year. So guess what? We push out electric vehicles to be built in 2022 instead of this year. We started to see things like resins or plastic supply, which ultimately originate many of those raw materials come from China. And of course, the whole transitioning or transporting of materials to North America has really had issues. So our plastic supply, you can't build and finish a bus without the interior plastic panels, for example. Our window suppliers had challenges with some of their raw material supply. And then, of course, in some of the key components, whether they be Cummins components or Allison or whatever, the whole microchip supply started to really impact what we would expect to get parts for the rest of the year. So what we decided to do, an unfortunate impact on our share price, is to be completely transparent with our investor about, look, we've got these realities. We have an uncertain supply chain, it's way more prudent for us to slow down the current build production rates so that the last thing we want to do is have a whole bunch of buses lying around missing parts. We've seen that movie before where working capital goes through the roof. The other kind of simple reality, if we don't install a product or a part in station on the production line, and there's no robotics, they're hand built effectively on this assembly line. For every hour in station, there's 3 to 4 hours out of station to rectify it if you don't get it right the first time. And then there's the cascading issues. You can't install the seats unless the floor is in the bus, and so on and so forth. So that whole reality in literally in the last week or two about the implications for the rest of our third and our fourth quarter deliveries resulted ultimately in the pushing of work into 2022 and not completing it. And then rather than slow down the factories, so instead of an X production per week, go to Y production, we've chosen to continue to do what we've done for the last 18 months, which is idle certain plants at certain times for a week at a time. So we still keep the machine operating roughly at the same production levels, but it works for less weeks. And that allows us to keep the efficiency of the machine and all the support network to go with it, but also to keep the people employed and where they're off for a week or two, working with whatever unemployment's available to keep them, as whole or as best as we can in that respect. So that's what really led to the guidance. We board meetings all last Friday, going through the details, the forecast, the initiatives, which led to the reality is that we need to let our shareholders know this as soon as we could, and that's what happened to close of business on Friday.
Yeah, and I mean, I think it's been an issue facing a lot of industries. If misery likes company, there's a lot of company exiting 2021 here in terms of a lot of the same issues you just highlighted. One of the questions I've had, and one of the questions I have is, do you think your situation has been exacerbated because, to your point, you're a smaller industry within the broader vehicle manufacturing space? Do you think suppliers who are all facing some friction here are maybe prioritizing delivering to like the GMs of the world and the Fords of the world, where you're selling millions of vehicles? Yeah, and that's pushing on you a little bit as well.
It may have an impact, Kevin, but as I said a minute ago, we don't buy microprocessor chips ourselves, right? We buy a part that comes from a Cummins or an Allison. Now they're global manufacturers, and so they, just like Ford and GM, are in line for those global components that they need to finish their product. A little bit compare and contrast. We can't finish a bus, therefore we can't deliver it, therefore we can't take rev rec or invoice the bus because we don't have a windshield or the plastics on the interior. On our parts business, though, we can take an order for $100,000 worth of parts and ship 90% of it and still get rev rec and so forth. So while our parts business has been impacted by certain levels of back orders of supply, we've actually doing really well in the parts business as the fleet starts to roll again and as these idled motor coaches start to operate again. So kind of short answer or longer answer to your short question, I'm not so sure we're getting out prioritized because we're not buying them directly. But we do, no question, have, our industry builds, for example, 6,000 transit buses a year, as opposed to, hundreds of thousands of F-150s in a field somewhere waiting for a certain component. And their world of retrofying that thing by bolting on a component is very different than our world, where we have such highly customized and varied product which is manually manufactured. Going back to the prudent thing to do was not to have fields full of buses awaiting parts and all the cascading problems associated with it.
And like, how are customers dealing with this? I guess you had your bidding activity has been good. I mean, you exited Q2 in a good spot. Are customers looking at this and saying, well, maybe we'll throttle back on our bids because deliveries are getting delayed for the issues you just mentioned, or does that still remain quite active like you saw or like you mentioned back in early August?
Kevin, in 2020, there is no question you had pick one, a transit agency in the middle of turmoil, trying to, how many buses do we operate? How do we, socially distance people? Craziness. And so all working remote, new for all of them as well. How do you get board approvals on programs and fleet replacement, and how do you update them and so forth? As we moved into 2021, they started to stabilize. We then were building to the schedule of known units. Sure, there was a customer that had told us, hey, hold us 10 slots. And by the way, they didn't get their funding in time, so we had to move those 10 slots and those kind of things. But remember, the bid universe that we work on, which is bids that are actively on the street today, those are programs where the money's already been appropriated. They have a vision that they want to buy 2 or 10 or 50 or however many buses. And they know full well that the bus they're placing today is 9 months or 12 months before they get it. So, I think you got to give credit to our customers. They're thinking about a public service that has a 15 to 20 year life of a product, and they're thinking about route structures and fleet replacement plans 5 or 10 years out. Short-term dynamics are not changing the way they think about what they buy. So, there's not as if anybody's pulled an RFP off the street tomorrow because NFI changed their guidance for deliveries. They're well aware of the dynamics associated with global supply chain. But what they have today, they've never had, meaning two things. In Canada, transit agencies historically, work with the cities and the provinces or whatever tax structures to pay for the assets. And now we have a federal government that's actually put a fundamental component of firm purchasing dollars associated with buying capital assets, and specifically zero emission vehicles and the infrastructure. They've given money to the Canadian Infrastructure Bank. So as much as that transit agents in Canada is still in turmoil, getting back up to proper rates, the ridership is still down and so forth, they're thinking 5, 7, 10 years out. I don't think that's changed. If anything, the tailwinds of the Canadian government support is only going to help enhance late 22, 23, 24, where they finally hit stride, and we hit stride back in a more supplyable or reliable supply chain. In the United States, we've always had a situation where the federal government paid 80% of the capital cost of a bus, and then the local municipality or state paid the 20. We have a new president and a new vice president, notwithstanding all their other challenges, that are dead serious on a couple things. They fundamentally believe public transit is a right and a responsibility in every city in America, very different to the previous administration. Number two, they want it to be green. And so the dollars they've put behind in terms of capital to buy buses, green buses and infrastructure is unprecedented. So kind of the same dynamic. And the other thing is the pressure from the politicians and the mayors of the cities. Boy, we got to deal with congestion. Every city in America is jammed. And while maybe people moved off of public transit during COVID, as they go back to work and back to their lives, those cities are jammed again. So we're kind of sitting in a bit of a sweet spot, in my opinion, for the next 5, 7, 10 years. Here's the other dynamic. When I joined, 13 years ago, I heard first that Uber and Lyft were going to put us out of business. They've turned out to be complementary to public transit. Then I heard subways and streetcars are going to kill your business. Well, I mean, in Toronto, right? That's a $10 billion 10-year bet. Now with zero emission, green buses, they smell different, Wi-Fi, seating, all kinds of stuff. It's a way different experience. And a city can make a massive impact on public transit in a very short period of time with a fraction of the dollars. So again, a bit of rambling, but context, the short term is no question. It's crazy right now, both for our customers and ourselves. Some of our investors worry about, hey, wait a minute, if you're going to push this stuff out, what about liquidated damages and what about cost escalation and so forth? Look, our customers don't live under rocks. They're very savvy in what we're doing. We talk to them all the time. Yes, contracts have liquidated damages clause, but we've been able to move schedules to accommodate their issues. And for the most part, we'll do that. You will see some minor liquidated damage. We don't expect any material impact on our business as we've adjusted the schedule. The other part about supply chain and cost of materials is everything that we're building right now was bid on and quoted last year. So yes, freight costs have gone up and surcharges and raw material and so forth. To some extent, that's for the stuff that we're bidding to build next year or in 6 or 9 months from now. And we have PPI indices and so forth. So we're not immune, but we're not massively impacted on kind of the delta between cost changing and price changing.
Mm-hmm. Are you throttling back, or is the industry maybe throttling back on the production slots or whatever word you want to use in terms of the open slots you have available because of some of the volatility in commodity prices? Like we're hearing this in other vehicle manufacturing sectors, like truck OEMs, for example, aren't necessarily opening up their full 2022 book because who knows what the price of steel is going to be and resin is going to be. So you don't want to get caught pricing for something that ends up looking a little bit different. Is that something you're managing as well?
No, we haven't seen that, Kevin. We've seen open slots moving and reducing and shrinking and changing based on the fleet replacement and the reality of the COVID dynamics. But we don't yet have customers trying to gauge the timing of pricing relative to when they'll take or buy a bus. And again, largely because it's government funded and the cost sharing structure. They're planning a much longer game than a private entity trying to figure out how they're going to buy a truck a year from now and then the value of it in the residual and so forth. We don't have those dynamics.
Mm-hmm. maybe taking a longer term view, you talked about some of the secular positive trends that should be beneficial to transit. The funding environment. What municipalities want. On the other side, Paul, I'm sure you've heard about people are going to drive more because of concerns around close proximity within public transit. People moving away from big cities, so the de-densification of urban centers might be negative for ridership. I guess when you talk to transit agencies, like how do they juggle those variables? Are they just always assuming everything moves up and to the right and things always get bigger, or
No,
or are they contemplating these new variables that seem to have popped up here, especially during the pandemic?
I tip my hat to our customers. These are really, while there's elements of their business that you could argue might be inefficient or difficult or lots of masters to work for, these people know their communities. And they have dramatically seen reductions in ridership. And we're probably back to, 50 or 60% of what we were pre-COVID. Every community different in terms of uberizing public transit. And we're going to see a shift of people. We've seen it, right? We all proved, there are a lot of us, that we can work from home. And so you're going to see a bit of a shift at how many go back to work 5 days a week, blah, blah, blah. But again, remember, their master is saying, I'm running a city, more cars on the road. All that does is mean more pollution and more congestion. Back to the point I just made in terms of I can make a fundamental impact by rapid transit, bus rapid routes that are dedicated roadways and moving a high velocity of people for a fraction of the cost of putting in a subway and those kind of things. The proximity of people, I think to some extent, I could be wrong, but that, in my opinion, that's more of the current or temporary dynamic around, wave 3, wave 4, and how much the vaccination take up and Delta variants and so forth. Look, we're seeing motor coaches move again. We're seeing sports events in the U.S. We're seeing universities back in class. We're seeing, malls opening up and so on and so forth. There's a pent-up demand for people wanting to get together. So back to my customer, the transit agency, they're very savvy at thinking about how they're replacing their fleet. They're upgrading their 5-year replacement plans. They've got the tailwind of pressure around going zero emission more than any other industry, because it can have a massive impact on any greenhouse gas emission goals in the next 5 years, which is massively topical and on all the politicians and quite frankly every person's agenda.
Right. And there's a question that's come through here, and you did answer this a little bit, but maybe if there's any incremental detail you want to provide. So I guess just practically speaking, if you're delayed in delivering a bus, just like what are some of the penalties you face? You talk about liquidated damages. Is it just primarily that if you're late, there's liquidated damages unless you can negotiate out of it? Are there other things that you can negotiate, other penalties that you may or may not face?
No, and I'll generalize here. Depending on the customer and the contract, they'll have a couple $100 a day for a liquidated damages if your bus is not on time. Now, the vast majority of our contracts have delivery windows, not delivery dates, right? And again, highly engineered, it's a little bit like house acceptance. If you build a house, they give you a date, and then depending on changes and so forth, the whole thing moves left and right. Where customers have a committed service they need the product for, and the product's not there, they've got to rent vehicles or resurrect or maintain vehicles, they may be a little bit more aggressive on liquidated damages. All through 2020, the amount of liquidated damages was negligible. I can't think of it being couple hundred grand in totality. And so we are very savvy in working with our customers. Some will maybe hold us to the book. Others will be very flexible in adjusting and adapting, the delivery schedules.
Okay. I'm going to go back to your analyst day prior to the pandemic. I think one of the things you mentioned then was, I guess, a bit of a pause in larger orders because of just transit agencies needed to figure out how they're going to transition to EVs or ZEVs. Where we sit here today, given the funding, have you seen all the major transit agencies move past this, I guess, call it friction point? Like, are they now in a better position to order ZEBs the way they would have ordered a diesel or CNG bus in that type of size and quantum? Do they have all the necessary information at hand to kind of make that big step forward effectively?
It's a really good question. It's not a light switch. It's more of an evolutionary game. So if you and I were running, I'll pick one of our customers, King County in Seattle, big trolley electric fleet, big hybrid electric fleet, wanted to decide what they were going to do with zero emission buses. So what they did is they took, I think the initial tranche was 4 or 5. They did a bunch of testing. They bought a bunch from us, from Proterra, BYD. They tested like 15 of them each for about a year and a half and so forth. And got their heads around range realities, around charging, where they wanted them at the depot or en route, and all these other things, where they're going to get energy from. And then recently, ordered, I can't remember what it was, 40 or 50 of them from us. Kind of that's the vision of where we want to go. Most operators are doing exactly that. They went from the 1 or 2 pilots to, enough like 10 or 12 or 15 to really get their handle on, I can't just plug it in the corner of my garage. I got to think about energy. I got to think about all this other stuff. And we are now seeing some of these guys come up with some good substantial orders. Still not the days of, like our biggest contract, I think, was LA Metro for 900, CNG buses, not of that nature, but the 40s and the 50s and the 60s are now happening, as opposed to the 2s and the 3s and the 5s.
Okay. Got a, rapid fire bunch of questions come my way here across the app. I'm going to put some of these together. I think they kind of go hand in hand. So, looking past these shorter term issues, are you still confident in your 2025 guide? And then, I guess over the past week or so, given your revised guidance came out on Friday, but any customers exhibiting concern, with your balance sheet or maybe potential covenant renegotiations that might be required before placing an order, or any concerns from customers that are in your backlog today, given the update you provided on Friday?
Let's start with the second part of the question first, Kevin. Every single one of my competitors buys many of the major components from exactly the places we do. So the window guy that says, sorry, I can't give you enough windows this year, he's selling to my competitor. The air conditioning guy, the Cummins engine guy, the axle guy, all of those problems, the plastics guy, it's not like my competitors don't have the same issues. And it's not like my customer does not understand that. I have not heard one issue yet from any of our customers or even sales teams around a customer saying, oh my God, can I count on New Flyer or MCI or ADL to sell me a bus or be around 2 or 3 or 5 years now to provide the warranty and so forth. They have just gone through hell themselves in terms of their funding cycles, their operating tempos, their people. They get all that stuff. I'm not worried. We haven't had any cancellations of any significant. I think there was one of 15 options early 2020 that somebody has said, I have an order with you, I'm going to cancel it because I don't think you can provide, or because you're ultimately not going to be able to support me. So that I'm not really worried about. I'm really confident that we'll be able to continue to manage those customers' expectations and deliver them. And quite honestly, you've covered us long enough, Kevin. Our industry is not a simple one, and it's a highly engineered, highly customized, and it's dealing in a political world. So we've had lots of this over the last number of years. And, we've been around for 100, we're going to be around for 100 more. So I think we can stand behind that. We've not pulled back on field service or customer support. We've not pulled back on the parts support and so forth. With respect to 2025, if we stay at the highest possible level, unlike maybe some of the companies that are started in our space or in the EV space that said, hey, I made 100 buses last year, I'm going to make 20,000 3 years from now. Or some of these guys that haven't yet built a bus, but they're planning to build 15 or 20,000 and so forth. The way we built our 2025 was grassroots up, customer by customer, model by model, plant by plant. But we also tried to sanitize, check the whole thing. Let's think about kind of the macros for a sec. 2019, we did 320 million of EBITDA. And we only had Alexander Dennis for 5 months in there, or 6 months, okay? We did X number of units, and we stumbled in 2019 with some of our own internal fabrication supply chain. When we look at 2025, our assumptions are as follows. We've assumed volume gets back to roughly pre-COVID levels with a little bit of growth associated with maybe some more take up on EVs, not going from a 6,000 industry to a 10,000 industry, for example. Number 2, we've assumed effectively the same market shares with a little bit of uptake in some ZEB because we think we're confident in our product. Number 3, we've assumed a little bit of tail off on some of our parts business as some of our older models like Navi and Orion start to peel off, and maybe as the start of some of the zero emission impact starts to hit that market. We've assumed we're going to take out $75 or $70 million of our overhead on NFI Forward, which we're well into process doing. So to get from 320, a full year of ADL, a little bit more margin on zero emission, a cost takeout, getting to $425 million is well within back to normal, as opposed to a unrealistic promise of miracle has to happen, new products, markets have to triple, and that sort. So when we issued our press release on Friday, that exact question is where our board was saying, let's go back to your assumptions on what you guided or targeted for 2025. How realistic, or how many miracles had to happen to get there? My answer was, there's no miracles. This is the recovery of our industry and our business and the go forward associated with a zero emission plan.
And maybe another question in front of me here, and maybe you've kind of answered this in various parts through your answering of the other questions, but assuming there's no impact on demand from these supply chain issues, which are more of a supply issue, do you envision this being primarily just it's a delay, a push out of revenue rec, a push out of production? So for one, do you have the capacity to kind of, I guess, double up on deliveries, or whatever the incremental deliveries you'll need to catch up on, whether it's in late 2022 or early 2023? So does that become a bottleneck for you, or do you have the latent capacity to manage that? And then two, are you concerned about the fact that there could be any competitive pressure? Someone might take an order that might have otherwise been yours, but because of these supply chain issues, your inability to deliver that, somebody else takes that bus.
I'm not worried if we're going to win or lose the programs that we're bidding on right now. And by the way, the number of competitions on our table is at record level. Like, this is not a little bit increased. The busiest part of our business is our engineering team and our bidding teams, over the top. I'm not worried about somebody choosing somebody over us because of a supply chain concern in the short term. When it comes to 22 and 23, physical plant capacity is not our problem. It now is supply chain. But as we start to ramp up again, as we see today in any industry in America, less Canada, but America, the availability of people continues to start to raise its ugly head in different parts of the United States, which is going to put some pressure on the costs of labor and so forth. And so therein lies the continued desire for operational excellence, efficiency, and design and flow of plants, of make versus buy strategies in terms of what makes sense on some of the subcomponents. And then the other one that's really built ultimately into our 2025 is we know that battery costs continue to come down. We've chosen not to dive and put 100 or 200 million into a battery package facility. We've chosen to be the assembler of the batteries, but we'll let somebody else do that, because as the technology changes, the last thing I want to do is put a couple $100 million into a plant and have the battery strategy change. And ultimately, all you do is a little bit of research. At some point in the future, the battery chemistry and solid state batteries and all these things are going to come in. So we've chosen to be smart buyers and integrators rather than deeply invested in something that is changing rapidly fast. The trick for us is, of all the savings on batteries going forward, how much can we keep and how much are we going to hand over to our customer for competitive pressure? But that is all built into our 2025 forecast.
Mm-hmm. We got about 90 seconds here, and I got one more question that's come across. So just I guess a clarification on NFI Forward. Is that entirely incremental EBITDA, which I think you're targeting 67 million of EBITDA savings plus 10 million of incremental free cash flow? Or is there an offset there, like as you move to ZEBs, are there incremental costs you need to incur?
No, it is effectively, put it this way, we took our 2019 machine and we identified what costs of that we had to rationalize. It effectively is designed to be costs that are no longer in the business. Simple example, we took New Flyer and MCI with two different executive teams. There's one executive team. That cost is now permanently out of the business. We've been rationalizing parts warehouse facilities and so forth. That is permanently out of the business. The business going forward has nothing to do with NFI Forward. That was really around a little bit of a pivot from a pure holding company to an opco and a rationalization of overhead and SG&A costs.
Okay, that's helpful. Maybe just with the last 30 seconds here, just maybe an update on how NFI Forward is coming along. Has that been impacted by some of the issues you're facing in other parts of your business? No,
the first couple ones were kind of obvious, and I wouldn't say easy by any stretch of imagination, but were clear in execution. Slam the two businesses together, harmonize the org structures. We're now in the process of, we're well in the past. We flipped the switch. All of the MCI machine is now on Oracle. the same platform as New Flyer. And so procurement and sourcing and materials and the efficiencies that come with that have gone well. We went from 22 to, I think, 9 stocking locations. That's all done. Alexander Dennis eliminated one of their 3 production facilities and has moved, some of the people that were in that offsite to a warehouse or to an office type location. All those things have gone extremely well, and none have been impacted. The final series of projects around rationalization of facilities in North America. So we're eliminating some of the fiberglass locations and synchronizing them. We're eliminating some of the Alexander Dennis manufacturing capability and embedding it into the New Flyer facilities and those kind of things. It's got nothing to do with our supply chain dynamic.
All right, that's a great update there, Paul. We've run out of time. I mean, obviously a lot of stuff on the go. Best of luck as you get to the remainder of the year, and hopefully these supply chain issues are transient. I mean, a lot of industries would be hoping for that. And thank you again for joining us here today, and thank you everybody on the line for joining us as well. Have a great evening, Paul.
Thanks, Kevin. Much appreciated.
Thank you.